Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, June 20, 2018. You're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. So as you can see today, it was a very narrow-ranging day. It was a quiet day across many of the markets. There were a couple of standouts. We'll get to those in a little while. But in terms of the SPDRs, volume was relatively light. The narrow range really made for trading very difficult today. There was not a lot to do as it relates to the index itself. In fact, today's range was just over $1 from high to low. So the high, and I'll just move the chart over and we'll just take a peek. You can see here the high was 276.72 and the low was 275.59. So a narrow ranging day, light volume day as it relates to the S&P. So therefore, I really don't have a lot of change that took place today or as a result of today's activity. Everything remains the same. Everything we talked about yesterday as it relates to the S&P really remains the same. There's a couple of things that I want to make mention of, and then what I'm going to do, because I don't want to reiterate everything I discussed last night. I don't think that's fair to everybody. So what I wanted to do was think of something that would be beneficial and useful to everybody. So what I'm going to do in a couple of minutes is I'm going to explain, or at least give the answer to, one of the questions that I get most often is, how do I find trading opportunities in the morning? That's when the most activity occurs in the market. So therefore, traders want to know, how do I take advantage of the activity that exists when the opening bell rings for about the first, let's say, hour to an hour and a half worth of trading? That's really the prime time for trading. So the question always is, how do I find opportunity and take advantage of it? Because if you don't find opportunity first thing in the morning, chances are the market's going to go to sleep around lunchtime, and most of the time it really doesn't wake up at all, and trading becomes very, very difficult because a lot of the stocks that have movement in the morning have already done the movement. Therefore, the opportunities get thin, and we end up, as traders, looking for something to do. And that's one of the worst things a trader can do, is start searching for a trade because he or she feels like we have to be in a trade. We don't want that feeling that we have to be in a trade. We only want to be in a trade when the stock or market we're looking at sets up to where there's a high probability trade on the chart right in front of us. Other than that, we don't want to or need to take any risk unless we have a high probability trade in front of us. So we're going to talk a little through that today, and it's a little bit of a change, but hopefully it'll be beneficial, and I guess I'll find out after the fact in some of the comments whether or not it was beneficial or not. And what I'd like to do is ask you all, what else can I help you with? Meaning, are there things that I can discuss in these videos that you want to know about that would be helpful to the community? What can I help teach you? And we'll see what the feedback is in the comment section of the video. And based on the feedback, if there are some good ideas, and I'm sure there will be, we'll try and incorporate those into the evening videos. And by the way, let me make mention, please also hit the like button on the video. It's helpful to me. It helps get the word out to the community, and therefore it helps everybody. It's a circular world, and therefore that's how the world goes around. I'm trying to pay it forward so we can all pay it forward a little bit as well. So I thank you very much for hitting the like button, sharing the video with those people you think can benefit from this information. So let me make a few comments on the S&P, and then we'll get into some of the other markets and we'll start discussing how do you find opportunities in the morning. So there's a couple of things that I just want to make mention of. I'm still in the camp that we have another leg higher coming in this market. Nothing's changed. If you want to hear the detail on that, go to last night's video. Everything really remains the same. However, I just want to make mention and reiterate one more time, that doesn't mean we have to be completely out of the woods and can't have a down day or even a sharp decline in the midst of and not do any damage to the uptrend that exists that should ultimately take this market another leg higher. Something I mentioned the other day that I want to reiterate, tomorrow happens to be midsummer. It's also known as the summer solstice. Markets can either accelerate from an existing trend or actually reverse trend as a result of the solstice. We can't really hang our hat on that. It can happen. It's something to be aware of. So can we have a sharp decline tomorrow or even into Friday? Absolutely. Can we accelerate on the upside? Absolutely. I know it appears that I'm talking out of both sides of my mouth, but the summer solstice or the midsummer is not something that we can trade off of. It's something we need to be aware of. And here's what I'll make mention of. So the market went down for a few days in a row, had a nice intraday reversal yesterday, and then today we had that, narrow trading range day. Now, let's just say for argument's sake, and this is just something that we can put in our back pocket for the future, let's say yesterday finished as a down day and also today was somewhat of a down day or just a nothing day. Let's just say for argument's sake, we went down for 6 days in a row and we found ourselves over here today. Now, because we went down for 6 days in a row, I would expect that tomorrow, in concert with the midsummer or summer solstice, that we would see a trend change in the market, and I would be looking for a resumption to the upside. However, we had an intraday reversal yesterday. Today, the market was up a little bit, at least the spider was, but not a whole lot, so you can't really gain any information from today's activity. So with that being said, it can go either way. We can get an acceleration to the upside. Maybe yesterday was the reversal day. Maybe yesterday was essentially the bottom that kicks off the next leg higher. That's totally possible. And in the same breath, I'm going to say we can also have a sharp decline as a result of tomorrow's midsummer event. So therefore, you just have to be on guard. Keep in mind the 272.33. It can be 272.50. It could be 272. That's the general neighborhood that the market should find support if we did have a sharp decline tomorrow and or Friday. It also just so happens that tomorrow there isn't, I'm going to call it an economic event. It's not really an economic event as much as it is the Fed is doing a stress test on the banks. They've done that before, and they're usually a non-event. It's kind of like a checkbox. The Fed just wants to make sure that the banks have sufficient capital on hand in case of another event or crisis situation like we saw about 10 years ago. So they instituted this a long time ago after the financial crisis hit, and therefore tomorrow is another stress test. It just so happens that that stress test comes on the back of or coinciding with the midsummer or summer solstice. So I find that interesting. It has me thinking a little bit that there could be some negative connotations as a result of the bank stress or the Fed stress test of the banks. And what's in the back of my mind? The back of my mind is the XLF. We've been talking about this for a long time. We remember the weekly chart. This is a bearish pattern. We're hovering on the 50-week moving average. And you can see here today that while the market was up today, the S&P was up about 5 points. It's still up though. The Dow was down 40 points. It's more of a rounding error for the Dow. The Nasdaq was up nicely. The IWM was up nicely. We'll get to those markets in a moment. But the XLF continues to struggle. The financials continue to struggle. So either one of two things is going to happen. The stress test is going to be viewed as negative, and we're going to see a decline in the banks and potentially a decline in the markets. And it could be a short-term event. It doesn't have to be a long-standing decline, but it could be a 1, 2, or 3 day event. That's certainly possible. Or the stress tests are going to come out wonderful, and we're going to see what we've been discussing as the other side of the XLF equation is maybe the XLF begins to catch up with the other markets and we begin to rally, and the first item or the first order of business would be to get back above the 20-week moving average, which is the red sloping trend line on this weekly chart of the XLF. So I can talk about it till I'm blue in the face, but we're not going to see until we see, and we'll see maybe tomorrow or over the next few days. Let's run through a couple of the other markets, and then we'll get to how do you find opportunities. So here's the IWM. The IWM continues to power forward, up almost another 1% today. The IWM continues to make new highs. We made another new high today without a shadow of a doubt. So we're getting a little extended from the 20 period moving average on the daily chart. So it would be common and normal market behavior that the IWM is going to go sideways at some point, let the 20 period moving average catch up to price, or come down a little bit and come toward the 20 period moving average. Let price come back down toward the 20 period moving average. Think about it for a second. Even if we saw a 1 or 2 or 3 day decline across the markets, the IWM may come back down to the 20 period moving average, but does that really damage the uptrend? No, it doesn't. What happens if you go over to the weekly chart? The weekly chart, look how far away we are from the 20-week moving average. The 20-week moving average is right here. It's hidden by this upsloping trend line, but it's this red trend line. So that's the 20-week moving average. Look how far away we are. So we have a lot of white space in here to come down and retest some levels. And remember, here's a breakout at 160.63. I'm not suggesting we come down there. I'm just saying there's a lot of margin for error in the IWM. Even if we had a few down days in the market, is there really going to be any damage done to the IWM? Well, the net is we would have to come down quite a bit for serious damage to be done in the IWM. This is on a breakout, and what the charts are telling me is that higher prices are coming, and of course, the trend is our friend until the very end. The market will tell us when the trend is over. Right now, the trend remains up. Therefore, higher prices are coming. The transports, very similar story to the S&P 500 today in the transports. Not a lot of new information that we need to discuss. The transports were up about 10 points. So it was a narrow ranging day, just like it was in the SPY. So there's not a lot of new information in the transports. Same story as yesterday, nothing new to discuss. We can just move it along. The NASDAQ market, we'll take a look at the triple Qs, and we had a nice healthy up day in the triple Qs, similar to what we had in the IWM. So the IWM, small caps, and the triple Qs, technology, small caps and technology continue to drive higher. The triple Qs made an attempt at a new high today. They made a new high intraday by about 9 cents, and then they backed off a little bit. So we're butting up against the former high that was only made a few days ago. This market also remains in an uptrend. The trend is our friend until the very end. Doesn't mean we can't have down days. We can. But the down days don't have to damage the uptrend unless they do. If they do, we'll talk about it here. We covered the XLF already. I'm going to skip over a couple of the other markets like the XBD or the broker-dealer index. No need to go over that market. There's no material change. Same thing in the semiconductors, the SMH. There's no material change. Everything we discussed last night remains the same. We can move it along to the gold market. Gold continues to be under downside pressure. What's interesting is, and I'll show you in a second, a longer-term chart, but gold is at a very, very important inflection point, at least the way I look at the markets. And here's the bottom line. Gold has to find support right where we are right now. Otherwise, there's going to be more downside coming, to say the least. Why do I say that? Well, let me go over to a longer-term chart, and I'll show you exactly what I'm looking at. Here's a monthly chart, and you can see a trend line here. Now, we've used these trend lines on other charts in the past, and they generally work relatively well. If this trend line holds, which we're right up against the trend line right now at about 1270, give or take, if this trend line doesn't hold, we're going to start trading down to some other lower numbers based on some other important pivots in the market. A couple of important levels on the downside is 1255, and then right around that 1230, 1235 area as well. If that trend line on the monthly chart holds, we could have some upside in gold, but frankly, this chart doesn't look good to me. I don't necessarily want to own gold here based on this chart pattern on the daily chart. And then you can also see on the weekly chart, we've closed, we're trading below, and it'll be important to see where we close Friday based on the weekly close because of the 200-week moving average, where we've just broken below that to come up against this upsloping trend line. So I think gold is in a very, very important point right now, price-wise. Crude oil, you can see what happened today in crude oil. Earlier in the day, they spiked it up to the 20-period moving average and then backed off. Right now, we're hovering right around the 100-period moving average. We'll see if we can get any upside activity in crude oil. If not, we could see some more downside. Either way, there's no pattern here that I would put any capital against right based on this daily chart. I can certainly make the case that it's bearish, and I can also make the case that we've hit some important levels on the downside, and that should be satisfactory, at least for the short term, and we should see some upside activity. I can make both cases, and when I can make both cases, the best idea is to do nothing. By the way, I want to go back to gold for a second, and I want to go back to the monthly chart because I meant to make mention of something. This is something that we talked about recently, last night. We talk about it all the time based on other charts, and here it is again. See this breakdown candle, and you see the high of this breakdown candle? Look what the market did. It made a low, it rallied back to test the high of the breakdown candle twice, and here we are again trading back down away from that price level. Interesting, however, common and normal market behavior. Doesn't work 100% of the time, but as you can see, and I keep showing you the same thing on chart after chart after chart, it works the majority of the time. And you can use that information in two ways. If you're long the particular market that we're looking at, you know where a good exit point is, or at least a price where you should be taking some profit. Also, if you're willing to short a market on a chart that looks like this, then you know where you're wrong, and you can lose small and fast if you have to lose at all. And that's the objective, is to have the highest degree of certainty that you can, and at least know where you're wrong. Those are absolutely the best trades to take. All right, let's switch gears for a second, and let's talk about how do you find opportunity in the morning. And by the way, I just want to make mention that if you're not an intraday trader, that's okay. You can still utilize the information that we're going to discuss here, but you would use it on longer term charts, minimum of an hourly chart, but likely daily, weekly, and monthly charts. You can certainly use similar technique, similar information that I'm going to discuss now to use for swing trading purposes. You can use it for day trading, scalp trading, swing trading. Doesn't make any difference. We're going to take a look at how to find opportunity. And I think it'll become clear in a couple of minutes as we begin to go through the information. Why do I have a chart of Amazon up? Well, because I want to point something out. Is Amazon an opportunity? It's an opportunity if you're already long Amazon. If you're already long, you want to stay with this stock as long as you can and continue to let it rise higher and then move your stop up along with the stop or your trailing stop or however you want to do it. But the point is, you have to be able to ride these things like an Amazon, Netflix. If you're in these things for much lower prices, you can ride these things until they tell you there's a trend change at hand. So the question is, from an intraday trading perspective, was there an opportunity or is there an opportunity on a day like today for Amazon? Can you trade Amazon? Well, let's go down to a 10-minute chart and take a look at what we're seeing here. So you see we gap higher, and it was basically what's known as a gap and go. We gapped higher, market consolidated, and that was generally telling you that the market wanted to push higher, but I don't know too many traders, at least I can't do it. I can't buy a stock after it's already gapped higher and it's already at highs on the chart. To me, it just seems like asking for trouble. I, for one, have a very difficult time buying a stock at a high, let alone an all-time high. Momentum traders do it. It's just not my style. I find it very difficult to buy high and sell higher. So what do? So I have a watch list that I keep right on the side of my screen. I have several watch lists, but the one I'm going to show you has about 450 stocks on it. So here's the watch list. Now, right now, I have it sorted by the percentage gain for the day from highest down to lowest. So what I'm going to do real quick is, let's say we're coming in, it's around the opening bell rings, and the first few minutes of trading, I typically don't do much. I want to see what happens in the market. I want to see what stocks are moving. I'm watching the stocks that have decent gap higher or gap lower first thing in the morning. That's part of my Lazy Gap Trader course. A lot of you are in that. A lot of you trade the gaps in the morning with me. That's great. But the point of this is, what about outside of the gap trading strategy? How do we find other opportunities? Well, the first thing I want to note is that we're in an uptrend, meaning the major market. The market is trading in an uptrend. Therefore, I want to look for stocks that happen to be down early in the morning, because as the market gets quiet or as the market continues to rise, if I can find a decent support level for a stock, the odds are that that stock is going to find a low at some point in the morning and give me a decent rally throughout the day. It happens over and over and over again. The key is, can you find a decent support area? So what I do is I come in here, I sort the list the other way. I want to see what's down. As you can see, at least on my list, the biggest loser of the day was Starbucks, then is Oracle, HPE, and the list goes on and on from that. So what I want to do is I want to come into these stocks that are down first thing in the morning, and I want to see if I can find a decent support level for these stocks. You won't always be able to find a high probability support level, but remember, this coincides with everything that I teach in the course at Lazy E Mini Trader. So we're taking that information and we're marrying it together with what's happening now in the market. How do we find the opportunity? So let me point one out. For example, this is something that happened earlier today. So I'm going to move the watch list over a second, and we're going to bring up, which was the third stock on the list, HPE. So you could see HPE right out of the gate this morning started falling. So when I see a stock that's falling and it begins to show up toward the top of my list, I want to take a look at that chart and I want to see where a high probability support level would be. In order to do that, I'm going to continue to go up in terms of time frames on the charts. So from a 10-minute chart, there's nothing I could see here to the left. So I'm going to go up and I'm going to take a look at a 60-minute chart. What do I see there? Well, the first thing I see on the 60-minute chart is I do see a possible support level. I don't know just yet whether this is going to be a support level, but the first thing I see to the naked eye is a bottom. I see that this stock traded to a certain level and took off to the upside. Now, what that tells me is that that price level, in and around that price level right here, is important on this chart to this stock. Why? It doesn't make any difference why. Once a stock makes an important pivot, whether it's a pivot up or a pivot down, that price level tends to remain important on the charts. That's the reason the stock stopped there in the first place, but we may not have known that that price level was important when that initially happened here. But now that I could see that, I want to say, all right, what else can I see on this chart? So I'm going to go up and I'm going to take a look at the daily chart. And remember, once you get used to doing this, this all happens in a matter of seconds. I'm looking at multiple charts at the same time. I can run through stocks one at a time. I can see 4 charts on one of my screens all at the same time. I'm going to see a 60-minute, a daily, a 10-minute, maybe a 240. I move them around a little bit. So I'm going to see multiple time frames all in one shot, and visually, I'm going to see whether there's an opportunity here or not. And what I should say is a potential opportunity. Now, the picture becomes clearer. All of a sudden, I see this pivot that I saw before. This is the same one that we saw on the 60-minute chart. Here's another one. So the chart is already telling you that this price level, in and around this price level, is important. Now, when I go farther to the left, which is back in time, this is back in February. Now, this is a little bit lower. What price is this? Let's see. The low here was 1466. The low here was 15.12. So I know in between just north of 15 and north of 14.5, I have a lot of support for that stock. So far, I want to know where the support is likely to come in, and also, do I have a safety net below that? So there's another important pivot on this chart right here. 1466, I believe, was the number. Now I go farther to the left, and I see this consolidation area here. That's, again, the chart's way of telling you that this price level, in and around that price level, is important. Look, the stock made a high here, consolidated, right? And then it broke out. And once it broke out above here, it went up, came back down, retested it. What do we say? Markets like to come back and retest former breakout and former breakdown areas. That's exactly what happened here. The stock took off to the upside, and we did it again. We came back to test a former important level on the chart. So when I see all this, and I'm looking at this, and my eyes are trained to see this, and when you do this for a long time, you get better and better at it. It becomes quicker and quicker. That's just the way it works. Like anything else in life, the more you do it, the easier it gets. Now here's the thought process. I'm not looking to make this a long-term trade. I'm looking for, on a stock like this, on a $15 stock, and a scalp trade, and this is an intraday trade. I'm looking for 20, 25 cents. Maybe I'll get more, but I'm looking for something like that. So if it was a $40 stock, maybe I'm looking for 30 or 40 cents. A $100 stock, maybe I'm looking for 50, 75. I might even be looking, or might even get $1 out of the stock on a scalp trade scenario. I can hold them throughout the day. If they're in an uptrend, that's a whole nother discussion. That's part of how we maximize our trades. That's found in the course, and it's discussed in much more detail. I don't really want to get into that now. I want to focus on the opportunities. So in a case like this, what I do is I put a line on the chart. And the reason I put a line on the chart is because I can do that with an alert. I can use this line with an alert. So right here, I can say, alert me whenever the stock hits this particular line. So what I normally do is I put this line right now, right at this low where this pivot low was. You can see the low at $15.12. But what I would normally do is put this line slightly above the price that I want to enter the trade at, so I have enough time to react if I'm not watching the stock every single minute. So based on the information that I just discussed on this chart, I'm willing to take an intraday / scalp trade at that price on this stock. So let's go back down to the 10-minute chart, see what happened around that price level. Here it is, and you can see it didn't hit my line, missed it by a penny, but the low of the day was $15.13. And what happened? As soon as it hit that price, the stock took off to the upside, and just minutes later, within an hour, the stock was at a high of $15.37. Doesn't sound like a tremendous trade, but remember, it's a $15 stock. So the rally off that level down there is commensurate with the same type of rally that you would have seen on a $40 stock that might have been 30 or 40 or 50 cents. It's really all commensurate with each other. To most people, this looks like we're trying to catch a falling knife. But what the reality is most people don't understand why certain stocks will stop at certain prices. Most traders focus on short-term charts. Most day traders, intraday traders, focus on short-term charts. 1-minute charts, 3-minute charts, 5-minute charts. They don't really take the time to look at the long view, the bigger picture. Where are the support areas based on other charts that we're typically not looking at? I'm looking at them. I know other traders who are looking at them, but too many intraday traders are focused on the short-term charts. And the problem with the short-term charts is they're very fast, and they give you a warped sense of what's actually happening on the chart because it's moving so fast. For example, a 1-minute chart looks like there's big movement, but it could be like 12 cents, but it looks like the stock is really whipping you around. So hopefully that was helpful. That's basically the approach I take, and I'm happy to expand on this go ahead and ask questions in the posting section under the video. I'm happy to answer the questions. You can send me emails. Doesn't make any difference. You all know no question ever goes unanswered with me. Let me know whether this was helpful at all. If it was, great. We'll figure out more things that can be more helpful to you. And if it wasn't helpful, let me know that too. I don't want to start talking about things and discussing items on the charts that's not helpful to traders. This is absolutely about you, not me. So please let me know whether it was helpful or not and what else you would like to know, what you would like to learn. If it's something I can help with, I will. And if it's something I can't, I'll tell you. It's that simple. So with that, folks, I'm going to give it a wrap here tonight. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.